Imagine finding a stock trading at just 67 cents per share with analysts projecting it could reach $2.50, representing a potential 273% gain. But here's the really interesting part. This is a dog-focused retail company that just achieved something remarkable. They paid off $45 million in convertible debt and became completely debt-free. A company selling dog subscription boxes, toys, and even operating luxury dog airline flights, now expanding into 50,000 retail locations including Walmart, Target, and Amazon. Now I know what you're thinking. Pet retail has been challenging, and the stock has been beaten down significantly from its $2.56 high earlier this year. But here's what most investors are missing. Q2 2026 revenue came in at $107 million, beating expectations by over $3 million. Their retail segment just hit an all-time high revenue mix at 24% of total sales, growing 6% year-over-year. And their premium dog airline service, yes, you heard that right, Bark Air, posted $3.6 million in revenue, up 138% year-over-year with a 93% seat fill rate and 99% 5-star reviews. The company is strategically pivoting from pure subscription dependence to an omnichannel powerhouse. Management expects to reach adjusted EBITDA profitability by fiscal year end 2026, and they've done it without diluting shareholders or refinancing debt. With a strong buy rating from analysts and a price target of $2.50, about 273% above current levels, could this debt-free dog company be one of those retail turnaround plays that rewards patient investors? But before I reveal which dog-focused retail company I'm analyzing today, if you're new to smart investing, welcome. I specialize in finding undervalued dividend stocks, REITs, and turnaround opportunities that most investors are overlooking. I do the comprehensive fundamental analysis and research so you can make informed income investing decisions based on real data and emerging catalysts, not just market headlines. If you want to discover more recovery opportunities like this, companies with strong brands trading at beaten-down prices with clear paths to profitability, make sure you hit that like button and subscribe to Smart Investing. New videos posted regularly covering the best dividend and value opportunities across all sectors. Now let me show you which dog company could be ready for a major comeback. The company I'm talking about today is Bark Incorporated, trading on the New York Stock Exchange under the ticker symbol BARK. Bark is a vertically integrated, omnichannel dog brand providing products, services, and content for dogs across America and beyond. Founded in 2011 and headquartered in New York, Bark operates under a unique dog-first strategy. They create everything themselves: toys, treats, accessories, wellness products, premium food, and even luxury air travel experiences for dogs. Everything is designed, developed, and branded by Bark with a mission to make all dogs happy. The company operates in two main segments. First, their direct-to-consumer segment features BarkBox and Super Chewer, monthly subscription services delivering themed boxes of toys and treats directly to customers' homes. Second, their commerce segment sells products through major retail partners including Walmart, Target, Amazon, Chewy, and Costco, reaching approximately 50,000 retail locations nationwide. But Bark isn't just subscription boxes anymore. They've expanded into premium dog food with Bark in the Belly, donating 100% of profits to combat canine hunger, dental care products with Bark Bright, and perhaps most uniquely, Bark Air, a luxury airline service exclusively for dogs and their owners with white glove service, specialized cabin configurations, and concierge experiences. As of November 2025, Bark is completely debt-free after paying off their $45 million convertible note in cash, positioning them for accelerated growth and profitability. Here's where Bark becomes an intriguing retail turnaround play for growth-oriented investors willing to accept some volatility. First, becoming debt-free is massive. The company paid off $45 million in convertible notes, using cash from operations. No refinancing, no equity dilution. They also extended their $35 million credit line with Western Alliance Bank, giving them financial flexibility to invest in growth without the burden of debt service. This strengthens their balance sheet significantly and demonstrates management's confidence. Second, the omnichannel expansion is working. Their commerce segment delivered $24.8 million in Q2 2026, representing an all-time high revenue mix of 24% and growing 6% year-over-year. Retail distribution now spans Walmart, Chewy, Amazon, and Costco. Their holiday advent calendar sold out completely. This diversification reduces dependence on subscriptions and taps into impulse purchase behavior in physical stores. Third, Bark Air is exceeding all expectations. Revenue hit $3.6 million in Q2, up 138% year-over-year and 54% sequentially. With a 93% seat fill rate and 99% 5-star review ratings, this premium service demonstrates Bark's ability to innovate in high-margin categories. As affluent pet owners increasingly treat dogs as family members, luxury pet services represent a growing addressable market. Fourth, they're managing costs effectively. Operating expenses fell dramatically, and management made a strategic shift from box-to-bag delivery in their subscription service, improving margins. They're implementing price increases in commerce to offset tariff-related costs, and they're sourcing products from different geographies to mitigate supply chain headwinds. Fifth, the path to profitability is clear. Management expects to reach adjusted EBITDA profitability by the end of fiscal 2026. With improving gross margins, strong cost discipline, and revenue growth across all segments, the company is executing a clear turnaround plan. Currently trading at 67 cents, Bark presents a high-risk, high-reward opportunity for aggressive growth investors who understand retail turnaround stories. The analyst consensus price target sits at $2.50, representing approximately 273% upside, with a strong buy rating from Wall Street analysts. The bull case. If management successfully executes their plan and reaches adjusted EBITDA profitability by end of fiscal 2026, the stock could re-rate significantly. The debt-free status removes a major overhang and allows pure focus on growth. With retail expansion accelerating, Bark Air scaling profitably, and subscription retention improving, revenue growth should continue. Analysts project the stock could reach $2.50 to $3 over the next 12 to 18 months, representing 273% to 348% gains from current levels. The pet industry remains resilient even in economic downturns, as pet owners prioritize their animals' happiness. The unique positioning, subscription convenience, retail accessibility, and luxury experiences creates multiple revenue streams less vulnerable to single-channel disruption. If gross margins improve as management expects through pricing actions and supply chain optimization, earnings inflection could drive substantial multiple expansion. Trading at only 0.26x price to sales, Bark is dramatically undervalued compared to specialty retail peers, suggesting significant catch-up potential. Face the bear case. The retail sector remains challenged with consumer discretionary spending under pressure from inflation and economic uncertainty. Bark reported a net loss in Q2, and profitability remains unproven. Any delays in reaching EBITDA break-even could disappoint investors. The subscription base has been declining, with DTC revenue down year-over-year from $82 million to $78.5 million. There you have it, Bark Incorporated, a dog-focused retail company trading at 67 cents with a 273% upside to analyst price targets. With a debt-free balance sheet, expanding retail presence in 50,000+ stores, a fast-growing luxury airline for dogs, and a clear path to profitability by end of fiscal 2026, this could be an intriguing turnaround play for aggressive growth investors who can handle volatility. What do you think? Is the retail expansion and debt-free status enough to justify the risk, or are the profitability challenges and subscriber decline too concerning? Would you bet on this dog-focused comeback story or wait for clearer signs of sustained earnings? Drop your thoughts in the comments below. If this analysis added value, smash that like button and subscribe to Smart Investing for more retail turnaround and growth stock opportunities. Remember, this is educational content, not financial advice. Always do your own research and never invest more than you can afford to lose, especially in high risk, high volatility small cap stocks. Thanks for watching.